Hello friends and subscribers, a very warm welcome back to Readings in Impact Investing. My name is Daniel Rosehill. This is a brand new YouTube channel and an accompanying podcast, really more importantly, I would say the podcast, intended to read important documents in the world of impact investing. I have a couple of housekeeping notes to make at the opening of this particular episode. As this podcast is brand new, I was new to the world of podcast hosting, or at least I hadn't checked in on the options in a few years. So I have moved to a new podcast host called Spreaker, Spreaker, per the recommendation of Reddit, which is where I get probably a good half of my life advice these days. The podcasting subreddit was recommended as a good platform for folks who wanted to host a few different podcasts, and I definitely have a couple of podcasts floating around there in the internet. So I've signed up for Spreaker in order to try to bring back some order to my podcasting life, and it will be providing hosting. So all the links on the channel have been updated, the YouTube channel, and I'm going to add, as this podcast gets distributed onto places like Apple Podcasts, Spotify, and other places where people like to get their podcasts, I'll add those links onto the YouTube channel, so everything should kind of follow through. But at the moment, I'm just looking at my dashboard here. It's already up on Spreaker itself. It's on Apple Podcasts. It's on Spotify. It's on Google Podcasts. Oh, pending. Okay, so it's only pending. It's on the way to everywhere, essentially. So if it's not already on your favorite podcasting app, just be aware that because I would say I kind of screwed up the setup process here by moving to a new host after a few weeks. Because of that, there may be a couple of kind of old versions of this podcast, as in ones from my first host. So if you see something with only 5 episodes on a podcasting app, that is not the current feed. Check the YouTube channel and follow those links, and I will try to only put links that are to the podcast, the latest version of the podcast on those different platforms. So with that out of the way, one more thing in the intro is to give my email address. I'm doing this because if you are a reporting organization, you create reports, or you like to read reports in the world of impact investing, ESG, and sustainable investing, then do consider dropping me a line to say, hey, please read my report. This YouTube channel and podcast is done as a public good. I think that this information should be made available, so there's, needless to say, no charge for that. And I'm definitely eager to get more of this information out there. So the email address is public@danielrosehill.com. Rosehill is spelled Rosehill, or H as Americans call it, 2 L's in the end, and that'll get to me. So today I'm going to be reading from something by the IFVI and VBA. The IFVI, the International Foundation for Valuing Impacts, and the VBA, the Value Balancing Alliance, they put out this paper called General Methodology, Conceptual Framework for Impact Accounting Exposure Draft. And their idea was to set out their vision for impact accounting, which is something that has been referenced both in the 2021 Impact Taskforce report and the more recent one released just now in December, State of Play. Impact accounting has come up as a big recommendation, and the IFVI is basically working hard on developing globally applicable methodologies in tandem with the VBA. Now, this paper is a little bit older than the ones I previously read, because I'm looking here, it said comments to be received by October 16th, 2023. I can't remember when this came out. I think it was like the summer, like August. So I'm going to skip over certain parts of this document because their spec for comments is no longer relevant given that the commenting process is over. They have, just FYI, they have put the comments they got as a document on their website, so you can read through what people said about this. So I'm going to just read the parts of the document that talk about their vision for impact accounting. I'm not going to give the spec or the call for proposals. So I'm going to jump around a little bit more than I have in other readings. And here we go. This exposure draft is being produced by the International Foundation for Valuing Impacts, IFVI, in partnership with the Value Balancing Alliance, VBA, as part of the Impact Accounting System, abbreviation, the methodology. The methodology is a globally applicable and comprehensive open source methodology for valuing organizational, social, and environmental impact that is designed for incorporation into financial analysis and organizational planning and decision making. The methodology is governed by the Valuation Technical and Practitioner Committee, acronym VTPC, an independent committee comprising 18 members established by IFVI and authorised by its terms of reference to direct, validate and approve impact accounting research and methodology produced by the cooperation of IFVI and VBA. VTPC members are global leaders in the field of impact sustainability, accounting, business and finance. Members provide advice in their individual capacities as experts with composition and procedures designed to ensure independence, balance and the avoidance of conflicts of interest. Please refer to the full terms of reference for information regarding membership, voting and approval processes. I'm going to just skip forward a little bit now to the explanatory note. In January of 2023, the International Foundation for Valuing Impacts, IFVI, and the VBA announced that they had formed a partnership to develop a globally applicable impact accounting methodology that would be published as a public good. The ambition of the partnership is to advance the use of impact management, and in particular the practice of measuring and valuing with monetary techniques the impacts of corporate entities. The purpose of the methodology is to generate impact information that enhances the decisions of managers and investors related to sustainability topics. Further, impact accounting lays a foundation for the disclosure of impact information that addresses how and to what extent corporate entities create or destroy value for non-financial stakeholders. This document, the Exposure Draft for General Methodology 1 Conceptual Framework for Impact Accounting, is the first methodological statement published jointly by IFVI and VBA. The Exposure Draft introduces the system of impact accounting that will be developed throughout the methodology. The Exposure Draft also establishes key concepts, principles and definitions for the methodology. The Exposure Draft was developed by the technical staff of IFVI and VBA, with the project commencing in January 2023. General Methodology 1, Conceptual Framework for Impact Accounting, is the first statement in a series of statements that will describe the generalizable or cross-cutting components of the methodology. The research work plan of IFVI and VBA has been organised to set out the most fundamental elements in the methodology in the Exposure Draft prior to developing more specific impact pathways to the sustainability topic and industry-specific level. And I'm going to jump forward because the rest of this introduction is referring to the comment process, which, as I mentioned, concluded. They had the questions for comment, which were basically sort of text boxes intended to stimulate feedback. And as I mentioned, the feedback they did receive through that commenting process is available. You can just read it. It's on ifvi.org, which is their website. So it's about, I think, 100 pages. There's, some one-page letters, and there's some responses that are more like 10 pages. So they're varying in length, but they're up there on the website. So I've jumped to page 15 of this document because this is where we really get into the description of the methodology. The purpose, and there's going to be a little bit of repetition from the introduction. The purpose of this document is to introduce the impact accounting system that is being developed by the partnership between IFVI and VBA, and to establish the foundations of its general methodology, or the component of the methodology that is generalizable across topics and industries. The general methodology is to be developed through several methodological statements. This statement, General Methodology 1, establishes key concepts, principles, and definitions for the methodology. The methodology is a globally applicable system for measuring and valuing the impacts of corporate entities or an entity on people and the environment. In general, I don't really interject too often when I'm doing these readings, but I just want to highlight that the word globally applicable, very important, that the methodology they're developing is explicitly supposed to be globally applicable. For the purposes of the methodology, the valuation of an impact is understood to mean the use of a monetary valuation technique unless otherwise stated. The content of the methodology builds on frameworks and protocols published by leading organizations in the impact management ecosystem and sustainability-related disclosures required by governing jurisdictions and international standard setters. 1.2 Long-term vision for impact accounting. The long-term vision for the methodology is to develop a system of impact accounting that generates impact information that is as foundational to corporate and investor decision-making as financial information contained in general purpose financial reporting. Again, let me just read that one more time. The long-term vision for the methodology is to develop a system of impact accounting that generates impact information that is as foundational to corporate and investor decision-making as financial information contained in general purpose financial reporting. That's a big ambition. In contrast to general purpose financial reporting, the line between preparers of information and users of information in impact accounting is not clearly defined. The methodology is designed to be applied by either managers of an entity or investors in an entity to produce impact accounts. Impact accounts measure the positive and negative impacts of an entity on people and the environment. To produce impact accounts, it may be advantageous to have access to primary data of the entity. However, the methodology is flexible enough to be applied with potential limitations described throughout the methodology by investors to prepare impact accounts from an external perspective. Impact accounts are used to derive impact information. Impact information includes, but is not limited to, impacts that have been classified and aggregated for the purpose of presentation, supplemental notes that describe the assumptions, data, or methods used to measure and value impacts, and qualitative commentary that contextualizes impacts. The main users of impact information are managers of an entity, investors in an entity, and affected stakeholders of an entity's impacts. Impact information informs decision-making by interpreting impacts in comparable and understandable terms, specifically monetary units. Impact information is useful for considering trade-offs between different sustainability topics and between sustainability topics and financial topics. To prepare impact accounts, an impact materiality perspective is applied to determine which impacts to include in an entity's impact accounts. Impacts that are material from an impact materiality perspective are included in impact accounts regardless of whether they trigger or may trigger material financial effects on the entity. The impact information derived from impact accounts can be used to inform an entity's materiality assessment process. The monetary valuation of an impact in the methodology is performed from the perspective of affected stakeholders or society in general, as opposed to the perspectives of the entity. To a large extent, and consistent with general purpose financial reporting, impact accounts are based on estimates, judgments, and models rather than exact depictions. When impacts can only be estimated, measurement uncertainty arises. The use of reasonable estimates is an essential part of impact accounting and does not undermine the usefulness of the information if the estimates are accurately described and explained. Even a high level of measurement uncertainty would not necessarily prevent impact accounts from providing useful information. The vision for impact accounting is unlikely to be achieved in the short term because it takes time to socialize, understand, accept, and implement new ways of assessing corporate performance. Furthermore, limitations exist to impact measurement and valuation, including that the valuation of certain impacts in monetary terms may not always produce decision-useful information. Nevertheless, establishing a goal towards which to strive and continually addressing possible limitations is essential if impact accounting is to evolve so as to improve its usefulness. There are many ways to conceptualize and implement impact valuation. The methodology is intended to provide a credible and standardized approach that promotes the comparability of sustainability-related data at scale through monetary valuation. Additional approaches may nonetheless complement the impact accounting system as developed in the methodology. Architecture of the methodology, section 1.3. The methodology is developed through a system of interrelated statements. General methodology. The general methodology establishes the system of and conceptual elements for impact accounts, including the purpose, users of impact information, qualitative characteristics, fundamental concepts, impact materiality, and measurements and valuation methods. The general methodology is comprised of multiple statements, with this statement being the first. Topic methodologies. The topic methodologies include guidance for the measurement and valuation of impacts at the sustainability topic level. The impacts related to any specific topic included in an entity's impact accounts is based on the application of impact materiality. The topic methodologies are designed to apply across industries. See industry-specific methodologies. The industry-specific methodologies include guidance for the measurement and valuation of impacts at the industry-specific level. The industry-specific impacts included in an entity's impact accounts is based on the application of impact materiality. Industry-specific methodologies are developed in circumstances in which a topic cannot be generalized across industries. Let me just read that again, important to note. Industry-specific methodologies are developed in circumstances in which a topic cannot be generalized across industries. 12. Topic and industry-specific methodologies are published in the form of standardized impact pathways and may include additional information related to data sources, measurement and valuation methods, and resources that establish links between the activities of an entity and impacts. The methodology is designed with consideration given to practical feasibility and scalability. Additional documents may be developed to support interpretation and application of the methodology separate from the methodology itself. 1.4 Objective of the general methodology. The general methodology serves as the foundation for the methodology, meaning that it applies to all topic and industry-specific methodologies. The concepts of and methods for impact accounting are not inherently consistent across sustainability topics and industries. The general methodology provides guidance on the conceptual and methodological components that are generalizable. The objective of the general methodology is to develop a system of impact accounting and enable the development of topic and industry-specific methodologies based on consistent concepts, definitions, methods, and principles. Assist entities and investors to prepare impact accounts based on consistent approaches, and assist users to understand and interpret impact information that is derived from impact accounts. No content in the general methodology overrides guidance in topic and industry-specific methodologies. To meet the purpose of impact accounts, certain guidance may depart from aspects of the general methodology. The general methodology may be revised periodically, and revisions of the general methodology will not automatically lead to changes in topic or industry-specific methodologies. Section 2, Purpose and Applications of the Methodology. The purpose of the methodology is to produce impact accounts and generate impact information that enhances decision-making by entities and investors related to the sustainability performance of an entity. The same impact information can be used alongside financial information to assess trade-offs between sustainability topics and financial topics. Sustainability performance refers to the effectiveness of an entity in reducing negative impacts and increasing positive impacts. I think that's an important definition to repeat. Sustainability performance refers to the effectiveness of an entity in reducing negative impacts and increasing positive impacts. This is, of course, according to the IFVI VBA consortium. The methodology is established by the societal obligations of entities and investors to meet the needs of the present without compromising the ability of future generations to meet their own needs. The methodology is useful for entities and investors seeking to manage sustainability-related risks, opportunities, and impacts, but it further supports decision-making aimed at generating positive impacts that improve the lives of affected stakeholders as an objective in and of itself. Preparers of impact accounts and users of impact information. 2.2. Any entity in any business sector, in any geography, and at any organizational level can use the methodology to measure and value its impacts and prepare impact accounts. The methodology can also be applied by any investor in an entity from an external perspective to prepare impact accounts. For the avoidance of doubt, the methodology should not be applied to present impacts in a manner that is slanted in favour of positive impacts or is not neutral. For example, by emphasizing an organizational level of entity that has better sustainability performance than the entity as a whole. Impact information is derived from impact accounts and can be used for decision-making by the following users in the applications described below. The use of impact information is not limited to the scenarios described herein. A. Managers of the entity, including executives, finance departments, risk officers, and sustainability experts. They can all use impact information to inform decision-making related to corporate management, including business acquisitions, mergers and/or joint ventures, capital budgeting and investing corporate strategy, distribution, procurement and supply chain, employee compensation, engagement and performance targets, governance controls, processes and procedures, new market entry and restructuring, product portfolio decisions, research and development, and risk management. B. Existing or potential investors, lenders, and other creditors can use impact information reported in an entity's sustainability-related disclosures, or can prepare impact accounts from an external perspective to inform investment decisions based on evaluation of the sustainability performance of an entity and assessment of an entity's enterprise value, including consideration of risks and opportunities that arise from an entity's impacts. Affected stakeholders, including individuals or groups whose well-being is affected or could be affected by the entity's activities and its business relationships across its value chain. They can use impact information to understand the significance of the impacts caused by the entity, and affected stakeholders can use impact information to inform a range of decisions, including those related to consumption, employment, procurement, and policymaking. Section 3. Qualitative characteristics of impact information. For the purpose of preparing impact accounts, which include measuring and valuing the impacts of an entity and disclosing impact information in sustainability-related disclosures, the following apply. The fundamental qualitative characteristics of impact information, i.e. relevance and faithful representation, and the enhancing qualitative characteristics of information, i.e. comparability, verifiability, and understandability. The qualitative characteristics of impact information should be applied at the time when impact accounts are prepared and any impact information derived from those accounts is disclosed. Over time, the qualitative characteristics may no longer apply to impact information from prior time periods. Relevance. In general purpose financial reporting, the ability of information to make a difference in the decision of users is the primary consideration for the relevance of financial information. Whereas in impact accounting, the ability of impact information to influence the decision of users is not the sole criterion. While the methodology aims to generate useful impact information for decision-making, impact information may be highly relevant in its own right as a public interest activity. The relevance of the impact information related to any particular impact is determined by applying the following perspectives: the capacity of the impact information to influence the decision of users, the need for transparency as a public good and accountability towards affected stakeholders, and the significance of the impact on affected stakeholders. For actual impacts, the significance of the impact is based on the severity of the impact, while for potential impacts, it is based on the severity and likelihood of the impact. Severity is based on scale, how grave the negative impact is, or how beneficial the positive impact is on people's well-being, including the duration over which an impact lasts. Scope, how widespread are the negative or positive impacts. In the case of environmental impact that affects people's well-being, the scope may be understood as the extent of environmental damage or a geographical perimeter. In the case of impacts on people, the scope may be understood as the number of people affected. And irredeemable character, whether and to what extent the negative impacts could be remediated, i.e. restoring the environment or affected people to their prior state. The irredeemable character of an impact does not apply to positive impacts. In the case of a potential negative human rights impact, the severity of the impact takes precedence over its likelihood. The severity of a negative human rights impact is not limited to physical health. Highly severe impacts can occur in relation to any human right. Qualitative characteristics of impact information. Faithful representation. Impact information should not only represent relevant impacts, it should also faithfully represent the substance of the impact that it purports to represent. Faithful representation requires impact information to be complete, neutral, and free from error. A complete depiction of an impact includes all information necessary for the users to understand that impact. This includes information related to assumptions, data, and methods used to measure and value the impact. Impact information is neutral if it is not slanted, emphasized, de-emphasized, or otherwise manipulated to make it more likely that the users will receive that information favorably or unfavorably. It should consider positive and negative aspects of impacts. Positive impacts should not be used to obscure negative impacts in the presentation of impact information. Neutrality is supported by the existence or prudence, which is the exercise of caution when making judgments under conditions of uncertainty. The exercise of prudence means that positive impacts are not overstated and negative impacts are not understated. Equally, the exercise of prudence does not allow for the understatement of positive impacts or the overstatement of negative impacts. In cases of uncertainty, preparers of impacts accounts should default to avoiding the overstatement of positive impacts and the understatement of negative impacts. Impact information can be free from error without being perfectly precise in all respects. Information that is free from error implies that the entity has implemented adequate processes and internal controls to avoid material errors. The amount of precision needed and attainable and the factors that make information free from error depend on the nature of the information and the nature of the matter it addresses. For example, being free from error requires that factual information is free from material error, descriptions are precise, estimates, approximations, and forecasts are clearly identified as such. No material errors have been made in selecting and applying an appropriate process for developing an estimate, approximation, or forecast, and the inputs to that process are reasonable and supportable. Assertions are reasonable and based on information of sufficient quality and quantity, and information about judgments about the future faithfully reflect both those judgments and the information on which they are based. Comparability. Impact information is comparable when it can be compared with impact information in previous periods and with the impact information of other entities, in particular those with similar activities or operating within the same industry. Consistency is related to but is not the same as comparability. Consistency refers to the use of the same approaches or methods for the same impact from period to period. Consistency helps to achieve the goal of comparability. Maintaining consistency does not preclude the possibility of improvements and revisions to the methodology. To maintain consistency, changes in the methodology over time may require an entity to recalculate certain impacts when comparing impact information across time periods. Comparability is not uniformity. For information to be comparable, like components should look alike and different components should look different. Comparability of information is not enhanced by making unlike things look alike any more than it is enhanced by making things look different. Verifiability. Verifiability helps to give users confidence that impact information is complete, neutral, and free from error. Information is verifiable if it is possible to corroborate either such information itself or the inputs used to derive it. Verifiability means that various knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. Impacts should be identified, assessed for materiality, measured, valued, and disclosed in ways that enhance their verifiability. For example, using information that can be corroborated by comparing it with other information available to users about the entity, about other entities, or about the external environment, and providing information about assumptions, data, and methods used to measure and value impacts. Understandability. Impact information is understandable when it is clear and concise. Understandable information enables any reasonably knowledge and willing user to readily comprehend the information being communicated. The completeness, clarity, and comparability of impact information rely on the impact information being presented as a coherent whole. For impact information to be coherent, it should explain the context and the relationships between the related assumptions, data, and methods used to measure and value the impact. Individual impacts may be aggregated or categorized to enhance the clarity of impact information, but never in violation of neutrality or to the point at which topic or industry-specific context is lost. The level of information, granularity, and technicality should be aligned with the needs and expectations of users. Abbreviations should be avoided, and the units of measure should be defined and disclosed. Use of the enhancing qualitative characteristics of impact information. Enhancing qualitative characteristics should be maximized to the extent possible. However, the enhancing qualitative characteristics, either individually or as a group, cannot make impact information useful if that information is irrelevant or does not provide a faithful representation of what it purports to represent. Applying the enhancing qualitative characteristics is an iterative process that does not follow a prescribed order. Sometimes one enhancing qualitative characteristic may have to be diminished to maximize other qualitative characteristics. For example, a reduction in comparability may be worthwhile to improve relevance or faithful representation. Chapter 4, Fundamental Concepts of Impact Accounting. Impact as the basis for impact accounting. To establish a system of impact accounting, several fundamental concepts must be defined. Those concepts are introduced and defined in this section. Whereas general purpose financial reporting is grounded in the concepts of assets and liabilities, to report an entity's financial position, and income and expenses, to report an entity's financial performance. Impact accounts, however, are measured in the concept of impact. The unit of measurement for impact accounts is monetary. The definition of impact. Impact can be defined as a change in one or more dimensions of persons' well-being directly or through a change in the condition of the natural environment. Repeat that again. Impact can be defined as a change in one or more dimensions of people's well-being directly or through a change in the condition of the natural environment. An impact can be actual or potential, intended or unattended, and positive or negative. Impacts in the methodology are valued using monetary valuation techniques, and as a consequence, impact is defined through a human perspective due to limitations associated with measuring the intrinsic value of nature. To the extent possible, the methodology will over time consider effects on the natural environment independent of any relationship to humans. An impact is potential in nature when its effects have a degree of uncertainty in that they may have occurred in the past or may occur in the future, subject to a degree of likelihood. An impact is unintended when its effects were not the aim or expected result of an entity's activities. An impact does not have to be directly observed to be included in impact accounts. In many instances, the measurement and valuation of impacts are based on models rather than depictions of real-time changes in people's well-being or the condition of the environment. Comparisons between financial and sustainability topics. The creation or erosion of value related to the well-being of people can be analysed as a system of flows and stocks, in which flows of value are represented by impacts and stocks of value are represented by capitals. Capitals are defined as the resources and relationships affected and transformed by the entity's impacts. General purpose financial reporting measures the creation or erosion of value for specific types of financial capital, such as the equity of an entity, whereas impacts can primarily be represented as changes in various types of non-financial capitals. Alongside one another, general purpose financial reporting and impact accounting, aided by the use of monetary valuation techniques, lays the foundation for a comprehensive assessment of an entity's performance across capital types. Impact pathways. An impact pathway describes the series of consecutive causal relationships, ultimately starting at an input for an entity's activities and linking its actions with related changes in people's well-being. Impact pathways provide a consistent method to measure impacts, allowing for comparability across time and between entities for a specific sustainability topic. Impact pathways consist of the sequence of events shown in Figure 1, which is a flowchart showing from left to right, input, activity, output, outcomes, impact. Impact pathways consist of the sequence of events shown in Figure 1 and described below. Input, the resources and business relationships that the entity draws upon for its activities. Activities, everything that an entity does, including operations, the procurement of inputs, the sale and provision of products and or services, as well as any supporting activities. Activities span a large number of different actions that altogether contribute to outputs and ultimately outcomes and impacts. Output, the direct results of an entity's activities, including an entity's products, services, and any byproducts. Outcome, the level of well-being experienced by people or condition of the natural environment that results from the actions of the entity, as well as from external factors. Outcomes are used to describe the one or more dimensions of people's well-being that are affected by an input, activity, and or output. Impact, the change in one or more dimensions of people's well-being directly or through a change in the condition of the natural environment. As such, the term outcome describes a resulting state or condition, where impact refers to the change and evolution in the state or condition as a result of the entity's activities. Impact drivers refer to the sequence of an entity's inputs and outputs that may have positive and or negative impacts on people's well-being. Impact drivers are typically input or output related data that are measured by the entity. The boundaries between the different elements of the impact pathway, particularly outcomes and impacts, are dependent on the nature of the underlying phenomena. In some cases, certain components of the pathway may be implicitly modelled in the monetary valuation. In others, certain components are not relevant. This may depend on, for instance, the specific sustainability topic or industry of the entity. An impact does not occur in isolation, but in relationship to a reference scenario. A reference scenario is the set of activities and related outcomes that is assumed to happen in the absence of the entity's activities. A reference scenario assumes that the entity's activities and any comparable substitutes do not exist. A reference scenario does not assume that the activities of the entity are replaced by a competing entity that conducts its activities in a similar manner or provides the next best alternative. The reference scenario for an impact pathway should be disclosed to users of impact information such that it is clear what is measured in the impact calculation. 4.6 Monetary valuation. Impacts can be valued from the perspective of the financial opportunity or risk to the entity or from the perspective of the affected stakeholder. Monetary valuation in the methodology is performed from the perspective of the affected stakeholder. In some instances, an impact cannot be isolated to a single affected stakeholder group and is valued from the perspective of society in general. That's quite important. Section 4. Fundamental concepts of impact accounting. While impact accounts are valued from the perspective of the affected stakeholder or society in general, they may be used to inform assessments of an entity's dependencies on people and the environment. Dependencies occur when an entity's impacts or changes in the external environment in which it operates affect an entity's cash flows or future cash flows, and therefore create or erode investors' determination of its enterprise value. Monetary valuation of impacts from the perspective of the affected stakeholder refers to the estimation of the relative importance, worth, or usefulness of impacts to the people who experience the impact, expressed as a monetary value. Impacts can be experienced by people directly or through changes to the planet or the economy. An anthropocentric approach is utilized whereby any change in the condition of the environment is valued from the perspective of the impact on human well-being. The valuation of an impact is typically performed with a monetary value factor. The well-being of people cannot be separated from social contexts, and the valuation of impacts should consider local or regional differences to provide relevant information. Stakeholders are defined as those who can affect or be affected by the entity. For impact accounts, the affected stakeholder groups are of central importance. Affected stakeholders are individuals or groups whose well-being is affected or could be affected either positively or negatively by the entity's activities and its business relationships across its value chain. Common categories of stakeholders are authorities, including central banks, governments, regulators, and supervisors, business partners, civil society, employees, other workers, and trade unions, consumers, customers, and end users, existing and potential investors, lenders, and other creditors, local communities and vulnerable groups, non-governmental organizations, and suppliers. Nature is considered to be a silent stakeholder in that nature is affected by the impacts of entities, but it is the responsibility of people to act as stewards of the environment. Time periods and accrual impact accounting. The time period for which an entity measures its impacts can be customized depending on the type of impact information that is required by users. For the purposes of disclosing impact information in sustainability-related disclosures, this would normally be the reporting period of the entity, but impacts can also be measured for the period of a specific project or the life of a product. Impact materialize over time, and many impacts triggered by an entity's activities do not materialize within the period being considered. Impacts that do not materialize in the period may have materialized in a prior period, or they may materialize in a future period. For example, an impact can have materialized in a prior period when it affected a stakeholder in the entity's upstream value chain during the manufacture of an input that the entity draws upon for its activities in the current period. But an impact can materialize in a future period when a good that the entity manufactures in the current period affects a stakeholder in the entity's downstream value chain in a future period. Accrual impact accounting depicts the impacts on affected stakeholders in the period in which the related activity of the entity occur. Impact accounts for a particular period should reflect all of the impacts connected to activities of the entity that occurred in the period, even if the impacts materialized in a prior period or may materialize in a future period. Section 410, Attribution of Impacts. The attribution of an impact refers to the portion of an impact that is reflected in an entity's impact accounts. All impacts included in impact accounts should be assessed for the appropriate level of attribution to the entity. An entity can be wholly or partially responsible for an impact. The attribution of an impact should consider the responsibility of the entity. If the entity has control over the activities that cause an impact, even if the impact exists in a system that other entities are linked to, it is likely that the entirety of the impact should be included in its impact accounts. Direct impacts that are caused by an entity are likely fully attributable to the entity, whereas direct impacts that are contributed to by the entity and indirect impacts may be either wholly or partially attributable to the entity. The inclusion of the entity of an impact by an entity in its impact accounts does not preclude another entity that is linked to the impact from including the entirety or a portion of the impact in its impact accounts. The direct impact of one entity can be the indirect impact of another entity in the same value chain. This approach to attribution creates the potential for double counting of impacts across the value chain. Double counting occurs when an entity wholly or partially recognizes an impact in its impact accounts and another entity in the same value chain wholly or partially recognizes the same impact. This approach to attribution allows for complete information on value chain responsibility at the entity level. Beyond the responsibility of the entity, the attribution of an impact should also consider the capacity of the impact information to meet the decision-making needs of users. Additional guidance on attribution will be developed in topical and industry-specific methodologies. Section 5, Impact Materiality and the Preparation of Impact Accounts. Before a preparer, whether an entity or an investor from an external perspective, can use the methodology to prepare impact accounts at a point in time, the impacts of the entity under consideration must be identified and an impact materiality perspective must be applied to determine which impacts to include in impact accounts. Impact materiality serves as the basis for impact accounts. Impact materiality is an entity-specific aspect of the relevant fundamental qualitative characteristics of impact information. Irrespective of the financial materiality of an impact, impact materiality serves as a sufficient basis to prepare impact accounts. As part of generating impact accounts, the relative importance, worth, or usefulness of impacts to people and the environment is assessed through monetary valuation. As a result, the impact information derived from impact accounts provide a data-driven and empirical foundation to support an entity's materiality assessment process. Ultimately, the process of identifying impacts, measuring and valuing them to understand their significance, and assessing them from an impact materiality perspective is an iterative and ongoing process. 5.2. The preparation of impact accounts. To prepare impact accounts, an entity or an investor from an external perspective should consider the following steps. Steps related to impact identification and measurement. Understand the sustainability context of the activities and business relationships of the entity under consideration. Identify impacts through engaging with topic and industry-specific research, relevant stakeholders and experts, and measure and value the impacts identified to understand their significance. Step 2. Prepare impact accounts at a point in time. Apply an impact materiality perspective to determine which impacts to include in the entity's impact accounts. The first 3 steps relate to the entity's ongoing impact management process or an investor's ongoing assessment of sustainability performance. These steps allow the entity or investor to actively manage and assess impacts as they evolve and as new ones arise. In step 4, the preparer determines which impacts to include in the impact accounts for a particular time period. Sustainability context, impact identification and measurement and valuation. The following areas should be considered to understand the sustainability context of an entity's activities and business relationships. Economic, environmental, human rights, and other societal topics that affect the well-being of people at local, regional, and global levels related to the entity's sectors and the geographic location of its entities and business relationships. The entity's responsibility regarding the authoritative intergovernmental instruments which it is expected to comply with, and the entity's responsibility regarding the laws and regulations with which it is required to comply. An entity's stakeholders are central to the ongoing practice of assessing sustainability performance. Stakeholders need to be identified and consulted throughout the preparation of impact accounts. Their measurement and valuation of impacts should be informed by those affected by and to affect the underlying activities of the entity. The methodology is being developed to include standardized impact pathways at the topic and industry-specific level. Impact pathways in the methodology are a starting point to identify impacts, but they do not necessarily identify all impacts of the entity. A preparer should also include impacts identified as part of the entity's sustainability-related disclosures and impacts identified through an entity's periodic materiality assessment process. Impact materiality and the preparation of impact accounts. A material impact will always affect one or more stakeholder groups of the entity. To identify impacts, a preparer should identify impacts for each affected stakeholder category at each stage of an entity's value chain. A map that displays stakeholders and value chain stages may be a helpful tool for the identification of potential impacts, and that is available as Figure 4 on page 31 of this document. Impacts that have been identified should be measured and valued in accordance with standardized impact pathways included in topic and industry-specific methodologies. Impacts for which standardized impact pathways are not included in the methodology should also be measured, valued, and included in the entity's impact accounts. Their preparer should ensure that an impact pathway approach is utilized, the measurement and valuation process meets the qualitative characteristics of impact information, and that the impact measurement and valuation methods described in the methodology are applied as applicable. The application and scope of impact materiality. To prepare impact accounts, an impact materiality perspective should be applied to impacts that have been identified, measured, and valued to assess their relevance. A failure to include all material impacts in impact accounts results in incomplete impact information. An impact can be material if it pertains to the entity's material, actual, or potential, positive or negative, intended or unintended impacts on the well-being of people directly or indirectly through changes in the natural environment and over any time horizon. Material impacts can include direct impacts caused or contributed to by the entity's activities and indirect impacts that are directly related to the entity's own operations, products, or services through its business relationships. Business relationships include the entity's upstream and downstream value chain and are not limited to directly contractual relationships. Entity-specific impacts. When the entity concludes that an impact not covered or covered with insufficient granularity by topic or industry-specific methodologies is material, due to its specific facts and circumstances, it should provide such additional entity-specific impacts in its impact accounts. When measuring and value entity-specific impacts, the preparer should consider carefully comparability between entities while still ensuring relevance of the information provided, recognizing that comparability may be limited for entity-specific disclosures. The entity should consider whether the available and relevant frameworks, initiatives, reporting standards, and benchmarks provide elements that can support comparability to the maximum extent possible, and comparability over time, consistency of methodologies and disclosures is a key factor for achieving comparability over time. There's also a glossary that I'm going to read. The bibliography I will not read, but it is a useful list of papers for further reading. So let's just do the glossary. I'm just going to read the term and the definition. Term activities. Definition. Everything that an entity does, including operations, the procurement of inputs, the sale and provision of products and or services, as well as any supporting activities. Activities span a large number of different actions that altogether contribute to outputs and ultimately outcomes and impact. Source is the impact management platform. Business relationships. The relationship the entity has with business partners, entities in its value chain, and any other non-state or state entity directly linked to its business operations, products, or services. Business relationships are not limited to direct contractual relationships. They include indirect business relationships in the entity's value chain beyond the first tier and shareholding positions in joint ventures or investments. Source for that definition, European Sustainability Reporting Standards. Capitals definition, the resources and relationships affected and transformed by an entity. Source, impact management platform. Term impact definition, a change in one or more dimensions of people's well-being directly or through a change in the condition of the natural environment. Source not given. Impact accounting definition, the system for measuring and valuing the impacts of corporate entities and generating impact information to inform decisions related to sustainability performance. Source not given, I presume that means IFVI. Impact accounts, a set of accounts that contain the material, positive, and negative impacts of an entity valued in monetary terms. Impact drivers refers to the sequence of an entity's inputs and outputs that may have positive and or negative impacts on people's well-being. Impact information. Definition. Impact information is derived from impact accounts and informs decision-making related to the sustainability performance of an entity. Impact information includes, but is not limited to, impacts that have been classified and aggregated for the purpose of presentation, supplemental notes that describe the assumptions, data, or methods used to measure and value impacts, and qualitative commentary that contextualizes impacts. Impact pathway. Definition. The series of consecutive causal relationships, ultimately starting at an input for an entity's activities and linking its actions with related changes in people's well-being. Section 2 definition. Input. The resources and business relationships that the entity draws upon for its activities. Outcome. The level of well-being experienced by people or condition of the natural environment that results from the actions of the entity, as well as from external factors. Outcomes are used to describe the one or more dimensions of people's well-being that are affected by an input activity and or output. Output, the direct result of an entity's activities, including an entity's products, services, and any byproducts. Reference scenario, the set of activities and related outcomes that is assumed to happen in the absence of the entity's activities. Stakeholder. Stakeholders are defined as those who can affect or be affected by the entity. Sustainability performance, the effectiveness of an entity in reducing negative impacts and increasing positive impacts. Sustainability topic, a term used broadly to denote aspects of stakeholder well-being such as health, wealth and safety, or business activities or practices that are evidence drivers of well-being. This term is synonymous with sustainability matters, impact areas, or general issue categories, which are similar terms used by different standard setters. Sustainable development that meets the needs of the present without compromising the ability of future generations to meet their own needs. That source is Report of the World Commission on Environment and Development. And finally, value chain. The value chain of an entity is the full range of activities and business relationships related to the entity's business models and the external environment in which it operates. A value chain encompasses the activities and business relationships that entities use and relies on to create its product or services from conception to delivery, consumption, and end of life from the European Sustainability Reporting Standards. Hope that was helpful for those who are interested in impact accounting, and as further reports from the IFVI and VBA are available, I will also read them. And once again, please check out this podcast on YouTube. And if you also want to follow along with this as a podcast, Apple Podcasts, Spotify, Google Podcasts, and Amazon Music are just some of the places where this is available. Thank you for your listening and for your attention, and have a good day.